The government releases economic growth data for the third quarter of the current fiscal, that's the December-ended quarter, and the general expectation is that you will get a number which suggests that the economic recovery is gaining pace compared to what we saw in the second quarter. Let's look at the estimates. Bloomberg polls suggest that you will see GVA growth come in at 6.7% in the third quarter compared to 6.1% in the quarter before that. GDP growth is expected at 7% compared to 6.3%. Important to compare it also to the year-ago quarter, because remember the year-ago quarter is when we had demonetization getting announced, although the big impact of demonetization came in Q4. But in terms of level of activity or level of growth, you are expecting both GVA and GDP growth to return to the same levels that we saw in the third quarter of FY17. Remember, over this 18-odd months, we've seen two shocks to the economy. First, demonetization and then GST. And what all economists are watching to see is whether economic activity rebounds to levels that we had seen before these twin shocks. To gauge that, some of the sectors that are important to track are agriculture, manufacturing and construction. These are also heavy employment sectors, so important to track even from the employment standpoint. On agriculture, not much of a change expected. In fact, there could be a slight decline in growth levels from about 1.7 to about 1.5%, say economists. On construction, though, you are expecting a significant pickup. Construction had remained modest in the second quarter at about 2.6% growth. You are expecting a substantially higher number on construction. Manufacturing was strong last quarter, and the expectation is that that will continue to be strong, and perhaps growth in that segment would move up beyond the 7% that you saw in the second quarter. Those are the three major sectors to track, and those are GVA growth numbers. Apart from that, always important to see the expenditure side trends to try and understand what is happening in the underlying economy. One thing which had raised a glimmer of hope of a pickup in investment activity was the gross fixed capital formation number. That segment had seen growth of 4.7% in the second quarter. In fact, that was a 5-quarter high. People are now watching to see whether gross fixed capital formation continues to rise, and if so, is that a signal that there is at least a modest rebound in investment activity. Private consumption expenditure on the flip side was slightly weakish, not an outlier, but at 6.5% growth was slightly weaker than expected in the private consumption expenditure segment. But nobody really sees much or significant weakness in private consumption, at least not based on other high-frequency indicators. So perhaps that one will be steady as it goes. The final one to watch is government spending. Last quarter, you had seen government spending growth come down quite sharply, although there was base built into it as well. Remember, the second half of the year, the government's own finances have not been in the best condition. So some of the segments which get a boost from government spending may be weakish, and you may see government spending not accelerate as much as it has in some quarters in the past year to 18 months or so. The importance of the Q3 numbers is to the extent that it should fit into the full year growth estimates. The RBI now expects full year FY18 growth at about 6.6%. So you're basically going to retrofit that Q3 number to ensure that we are on track at least to meet that 6.6 number, or if we are on track to better that 6.6 number, because from here on, what everyone is watching to see is what growth recovers to in FY19. The RBI expects a pickup to about 7.2%, but any underlying trends in all of these data will help us solidify the forecast for the next fiscal year as well.